welcome to this session. Over the past few years, we've seen a real shift in how people engage with the markets. Retail investors, once a smaller part of the picture, have become a diverse, growing, and increasingly influential community. From Gen Z learning about investing on social media to new investors in emerging markets using fintech apps. Investing today is more open, digital, and personal than ever before. But this new wave also brings new challenges: gaps in financial advice, uneven financial literacy, and the rise of unverified voices online. So how do financial institutions, regulators, and the media work together to build trust and understanding in this fast-changing landscape? To explore this, we're joined by Natalia Gurseva, Head of Financial Markets and Resilience Initiatives at the World Economic Forum. So Natalia leads research and thought leadership on everything from financial stability to investor resilience. She's also the lead author of the Global Retail Investor Outlook, a report based on a global survey of over 13,000 participants across 13 countries, looking at how technology and behavior are reshaping investor participation worldwide. Natalia, it's great to have you with us. Welcome and thanks for being here.
Thank you so much. Thank you for having me, and thank you for letting me share some of the work that we're doing in hopes that it can provide some insights and help empower the growing investor base, to your point, to reach their financial goals, which is exactly what we're doing here. So let me then jump in. This is what we'll take maybe the next 20 or so minutes to do, and then you and I can have, I think, a bit more of an interaction after. But I'll tell you first about what we did in the background, the methodology, just to ground us in the research. And then I'll share some of the interesting insights about the investor behavior we're seeing, particularly focusing on younger investors and sort of the next-gen cohort. And we'll dive into a little bit of what we think are the key levers of empowerment, which is education, access, and trust. And then, of course, it would be remiss not to mention AI and sort of how that may shift the landscape as well. So, let's begin. So this research started in 2022 during the COVID pandemic. I think it will surprise no one on this webinar that we saw an uptick in investor interest. Of course, people had some more disposable income, maybe a little bit more free time, and so we've seen some upticks. And so we decided to explore this kind of nascent trend and did an initial survey of just 9 countries, about 1,000 respondents in each, to look at the behaviors and preferences of these investors. And then as we looked then in 2024, after analyzing the data and also doing a few deep dives into private markets and financial advice, we actually saw that this wasn't just kind of a cyclical reaction or an aberration to what was happening. This was a major structural shift in investor behaviors and in markets. So we relaunched the survey in 24 and expanded it to 13 markets and expanded our questionnaire to be able to continue building on this sort of time series compendium of data and insights. And we'll actually, a little spoiler alert, we'll relaunch the survey in 2026, growing our coverage yet again, and really trying to build this data-driven sort of resource for businesses, for educators, for policymakers, and for investors themselves. I will say that so this roughly shows you that we surveyed half females, half males, the age distribution, the country distribution. This is a biased sample. We wanted to survey more investors than non-investors because otherwise, of course, the insights wouldn't be as rich. And so, and we even saw that it's harder to find investors in certain markets than others, just because it's nascent and in some, but maybe more popular in markets like the US. And so, this is the definition of the retail investor for us. Once again, just to be transparent about our methodology, is an individual who invests in capital markets and kind of in a broad range of various products. And so, kind of to tie us into what brings us here today is, as I mentioned, market participation is growing quickly. And not only is it coming from investors themselves and the consumers, but it's really shifting capital markets themselves. And the retail assets under management are estimated to cross $100 trillion by 2030, which will be fundamental in not just how it's allocated, in the infrastructure that is needed to support it, and so many other pieces that are probably out of scope for this conversation today. I think we can also see outside of the market changes, this is a big conversation in other areas. We're talking, I think the audience here is probably quite global, but maybe with a European flair. And in Europe, there's a lot of conversations on how do we turn savers into investors. I think there's 11 trillion euros in bank accounts that could be deployed in capital markets. We also talk about the great wealth transfer, and I think there are $83 trillion that will change hands between the older generation and the younger generation, and these trillions will be deployed. So aside from just behaviors of investors, this will be momentous for capital markets. So once again, also, why are we doing this research? We're not just doing this to we're really looking at empowering investors to reach their financial goals. When we surveyed and honed in on why are people investing, it really is to build financial resilience, to reach medium and long-term goals. It's not shown on this slide, but to beat the market and sort of like more speculative is maybe only 10% of people we've surveyed. This is really rooted in being in the sort of driver's seat of your financial future as governments are more cash strapped, as maybe pensions are not as reliable as they used to be, and really thinking through, how do I build resilience? We also see that investors tend to be generally more confident than non-investors in reaching their financial goals. So investing is not the only way to reach financial goals, but being in capital markets is sort of one tool in your toolkit. And building confidence is another piece that we'll continue coming back to, that is empowering, that is engaging, etc. And you can see sort of, no matter what your financial goal, investors tend to be more confident. And then I know we're going to talk more about investors, but let's also spend a little bit of time on those who do not invest and why they don't do that. In large part, these are financially driven reasons. I don't have enough money, or I'm fearful of losing money, fearful of accessing it, so like liquidity and suitability. But also there's kind of a percolating maybe lack of trust and lack of confidence, like thinking that only institutions can really have opportunities to succeed, or maybe not feeling like I have adequate protection from the government. We're actually going to come back to this, but this is data from our global non-investor participants, or rather non-investor respondents. And I think that as we think to empower investors, another important thing probably for the audience here is to think of, how do you empower those who don't invest to take that first step too? Because it doesn't take a lot of money. You can have €5 or $5 and really kind of build like an incremental portfolio and really engage from a small base. And then, of course, also thinking through our next gen and our younger investors. I think there's a lot of conversation about younger generations investing earlier. And I think, as you can see here, many are starting to invest when they enter the workforce. Some of it is driven, of course, by employer-provided schemes and retirement opportunities. But I think what's interesting here is just the jump of starting to invest in early adulthood. We can see that the number for Gen Zs is twice that of millennials. Like, that is, I think, like a really material jump of interest. And thinking through that, sort of the famous adage, it's about time in markets versus timing the markets, really prolonging the horizon that you can be in the markets, where you can actually weather storms and cycles and really start building towards your financial goals earlier on. But not just investing, younger generations are learning about investing earlier. And as you can see here, many are starting to learn before even entering the workforce. Of course, that's driven by accessibility of social media and other things, and sort of your hand or your pocket. But once again, many many enablers coming together, which are good, but potentially have some risks as well. And then as we think about building confidence and sort of what would get people to invest more. Money is one, of course, because not having money is precluding people from investing. But if you look at this chart, it's really tied to learning how to invest, having a financial advisor, having suggestions from your networks. But also notice if I had more trust keeps percolating. So we're going to come back to this idea. And on the horizon, I had an AI chat to assist me, and we'll deep dive into some of this a little bit later. But there's this appetite to learn, and we'll dig into this. What I will say is that even if there are opportunities to learn and have access, this is actually one of my favorite slides to look at sort of how perception may differ from reality. So if you just look at the data comparing 2022 and 2024, you may think, oh, okay, investors feel like they can access products and they understand them better because sort of the bars keep going down. But if we dig deeper into this, we see that the perceived understanding of commonly traded products like ETFs, bonds, stocks is actually lower than the perceived understanding of crypto. And that people, for instance, know how to access more esoteric assets like cryptocurrencies much more easier than what we would consider more mainstream products like ETF stocks and bonds. And this, I'm not in position to give financial advice. I'm not adjudicating on where people should put their money, but I think it's an interesting lesson in engagement and sort of meeting people where they are. Crypto as an asset class has probably had the only kind of asset class wide like marketing push in the last few years. And so maybe this is also what makes people feel like they understand it and they feel like they can access it, which may be different from how traditional financial institutions feel about their ease of access. So I think that there's opportunity to meet people where they are, think about how we communicate around products and access, etc. And so it's not just sort of traditional learning, but really thinking through understanding and perceptions, not just kind of more common assumptions. The other thing I will point to is that how do people learn? So what are people comfortable with? And we can see this is a global set of data, of course, different by generations. Learning by doing is huge. And I think that this is probably what Norkon is also trying to think through how to enable is how do we make this accessible, right? How do we make people feel engaged and sort of like in the driver's seat? So I think that there's a big opportunity here. Of course, social networks play a big role, like as you can see, media and social media and friends and family. And then I'll also turn your attention to the bar graphs on the right, because once again, this ability to learn from AI chatbots, it was not something on our radar a few years ago, but is quickly gaining traction. And we'll, as I mentioned, dig a little bit deeper into that. And then not just learning, but when we think about services that younger investors use versus we'll call it Gen X or baby boomers, you can see how financial advisors, sort of like the formal role, is much more popular sort of with the older generations, and younger generations have almost picked literally everything else at the cost of a traditional financial advisor. And there's several reasons we're seeing for this. In many markets, traditional financial advice is just not available. So if we broke this down by geography, you would see nuances and differences. But there's also something, and I keep coming back to this, meeting people where they are. And financial advisors are typically like a man in a tie sitting in an office that you have to make an appointment with. There's sort of a transaction cost versus AI chatbots, budgeting applications. They're easy, they're accessible. When you go to social media, there's probably somebody there who's around your age, who looks like you, who speaks like you, maybe even speaks your language, that you just feel more comfortable with. And I'm not defending that choice because the incentives aren't always aligned. But this is, once again, how do we engage individuals and how do we empower them and make them feel comfortable, have trust and the confidence in a way that they find trustworthy and confidence building. What we also see is not just different patterns in services used, but those who do invest from the younger generations review and adjust and follow their portfolios more frequently than older generations. It may seem counterintuitive because they're going to be in the markets longer, they don't need to withdraw the money, but I think this once again harks to like availability of information, engagement, and sort of this general appetite to learn and learn by doing. And then we'll dig deeper a little bit about advice again, because that's a big piece. And so I think the key thing here, just a little bit of a downward trend in your traditional pieces. And once again, AI and AI chatbots potentially taking that piece of the market. And if somebody doesn't have access to a financial advisor, which is typical, where do people get some of their information, and how do they get information from traditional financial institutions? So I think the key thing here, once again, is that technology is really driving these behaviors. Of course, it's important across generations to have transparent and low fee structures. People care about being protected, etc. But there's, I think you just see a much bigger difference in AI use and robo advice. I think when I think we kind of talked about education and access and some of the behaviors and challenges there. Trust is a key component, and there's a general decline in trust in traditional institutions, and this is from financial institutions, large technology companies, fintechs, etc., that we see over time. It'll be interesting to see, of course, our 2026 data in a year's time, just to see how it develops. But I think that this is a really important point to capture and to really think through, like, how are you as an audience member, how are you like, as a financial institution or a member of the media, really thinking through trust, especially in this world where now, once again, it's AI that's taking up a lot of the kind of the airwaves. And then I know we mentioned that non-investors don't feel adequately protected by the government. I think there's a little bit of nuance in here, and that's why we wanted to show this more aggregate data where investors actually tend to feel protected. Non-investors don't. And maybe that's what's precluding them from investing. And so there's an opportunity, once again, in sort of meeting people where they are, thinking of how you engender trust, thinking of how you communicate protection, that will create confidence in investing. And I will say that this is also very much varies by geography, and where in developing markets, there's actually much more trust in being protected. And so a little bit to sum up, I think the key thing is that I think we've talked about that individuals value. Of course, it's building confidence, it's trust, it's cost, ease of access, and understanding. I think we rarely talk about, I think, feelings when we talk about financial markets, but this is about feeling. It's about feeling that I can access something. It's about feeling like I know what I'm doing, feeling confidence, feeling trust. And you can't prove it, but if an individual doesn't feel it, they're not gonna invest. And so, as I promised, we'll share a little bit more on what we saw in AI, and we'll keep digging deeper into those insights with the next iteration. I think interesting to see that there's just more and more trust in AI in managing investments, but also talking to an AI chatbot to learn. This is very much varied across markets. If the audience on this webinar tends to be European, you'll see Europeans actually trust AI much less than our emerging market respondents. This could be for a variety of reasons. Potentially that you've had access to more social safety nets and financial advice in a traditional sense. And sort of there's just a little bit more trust in some of these technological applications in emerging markets. And we see this not just in managing investments, but also how our in how are individuals learning to invest, because the ability to talk to a chatbot may just actually leapfrog the advice gap, so to speak. And so I know I've talked at you for 20 minutes, so thank you for allowing me to do that. But there's so much more that isn't in this presentation. So I would invite you to explore more insights through our Outlook, but also we have an interactive microsite that actually lets you play around with some of the data, which we'll hope to expand on as well. So we invite you to do that, and always feel free to reach out to us, as we always welcome interaction, questions, and sharing some of the insights we have. Thank you.
Thank you, Natalia. This is super interesting. I think, especially considering like for your next report as well, like with AI and the growth, like from chatbots that we typically saw 2 years ago over to more agentic AI and new ways of actually positioning AI in this landscape. I think that will be really interesting. But I think just a bit back to some of the first things you talked about with social media and young investors and so on, like especially like for influencers, especially in Europe, we see maybe more and more influencers popping up. So what you said as well, like many young investors rely on social media and influencers, or even someone within their close network or family, over professional advisor, like financial advisors, like you said, the older guy in a tie, or like the typical, like how they typically see it. But how does this like early exposure that you also mentioned, like starting to become earlier and earlier? So how does this early exposure to investing shape financial behavior?
Yeah. I think early exposure gets early engagement in one's financial future and financial goals, and that's such a good thing. I think talking about money is important. We all need money. We all need money for all of the things we do in life, and so I think that there's so much positive here, because it leads to thinking about financial decisions, and they're different at every stage of life, and so it also increases your time in markets and your ability to weather different cycles. And I think so I think this is from the sort of the individual, the consumer perspective. I think there are, of course, some potentially incentive misalignments with some of the influencers out there, because some of the rewards are based much more on like clicks and engagement and not on financial outcomes. And so I think there's just, if anything, to me, a lesson for more traditional financial institutions of how to communicate and how to reach their customers or their future customers. And so this is not about getting rid of the social media angle, but learning from like, what are the good pieces and ingredients that you can borrow? Yeah.
Oh, that's interesting. So I think most of the viewers today, they come from media, and maybe to some degree are perceived as closer to like the traditional financial institutions and so on. So but and in a way, some of the challenges, at least we've seen that trying to follow the media industry, and also both the alternative medias like social media and so on, and also traditional, is definitely misinformation out there that we need to counter. So what role should media organizations play in bridging this advice gap and countering misinformation around investing, while at the same time engaging younger audiences who increasingly turn to social platforms for financial education?
Yeah. I think it's a great question, and I think some of the things I also aligned with what you guys are trying to do, because if we notice that what is important to investors, it's cost, of course, financial impediments are big, ease of access and ease of understanding. So I think I'm not saying that everything needs to be free. I think free has its own implications, because if you're sort of not paying for something, you become the product. But I think there's really focusing on value. So that's access and understanding, not using jargon to really like the meet people where they are is what I'll keep saying. Is really key. And I think that slide I had that showed the perceived understanding or perceived level of access for ETFs, say, versus other products. Like people may just not understand what an ETF is because of that term. Stocks and bonds, similarly. Or I think we also see that the predictability of bonds or people's comfort with them changed from 22 to 24, largely driven because there's inflation that happened and interest rates changed. But without understanding that, your kind of perception goes to, oh, bonds are now risky, bonds are volatile, I can't trust bonds. I'm exaggerating a little bit here. So to actually answer your question, I think there's something around being accessible, not using jargon, but also focusing on outcomes and kind of explaining in a way that's accessible. So short form, it's personalized, it's not talking down, it's like really borrowing from what social media is doing well. And I will pause in a second, but I also think that for, we'll call it like traditional media sources, the next layer of competition might not be social media. It might be the AI chatbot, right? An AI agent. So I think that's the horizon. It's sort of like when Netflix said, our competition isn't TV, it's your sleep or your other free time, right? It's like your competitor is something else now.
That's really interesting. I think that's lots of the talks in the media industry in general as well. Like, how do you communicate to a new generation, younger generations, without being top down? Like more like in the social media where we have more a common tongue. Like, it's more a dialogue with the readers in a way.
Yeah.
I think it's probably that's where the influencers are successful as well, because people, you relate to the person, you can communicate in chats, whatever, and so on. Maybe places that maybe the traditional media have missed over time. But I think also, I know that one of the things that financial media institutions are talking a lot about is like, how can we educate our readers? Like, because like you said as well, like, what is ETF? What is all of these different terms and so on? So, and you've been closely involved in how banking, markets, and investor behavior have evolved over time. So in your view, how can like trusted financial media help people become more financially educated and independent?
Yeah. I think financial education is such a polarizing topic, and we believe in it. We have a whole separate initiative dedicated to it. So I want to be clear that this is very crucial and foundational. But I think anytime you say financial education or literacy, it once again sounds like patronizing, and you're like talking down, like I'm the expert. And so I maybe I would reframe it a little bit in, how do we destigmatize the conversation around money? Like a lot of people just don't feel comfortable talking about it. And this is, you see it more probably across genders. Like I think women feel much less comfortable. Men feel more comfortable. There's probably something around different geographies as well. But one is just, how do you make it maybe more commonplace and okay? Because once you start talking about it, then everything else follows. It in itself becomes educational, so to speak. And so I think that's part of it. And then how do you also make incremental progress and don't put everything on the individual? I think financial independence is great, and I think being your own chief investment officer may work for some, but most people have jobs and families, and it's just really burdensome to also then feel like, oh, now I have to learn about every stock out there and every bond and how to do portfolio construction and all that. Like that's not, I think that's not necessary, right? So I think there's something around just make it normalized to talk about money and don't put everything on the individual, but actually think through like, what can traditional financial institutions do? What can capital aggregators do? Like there's a big role for asset managers and pensions and other things here as well.
Oh, that's interesting. That's interesting. I think this is a bit off script as well, but
Go for it. Yeah.
but yeah, this is interesting. So, but this is also what we've seen. I remember like 20, 30 years ago, you had journalists, but they were also almost like brands themselves. Like you had a journalist in New York Times or big newspapers. Everyone knew who they were. And that has disappeared a bit with like the digitalization of the newspapers and media in general. But I think what we start to see on some levels, at least in media industry in general, is more like social media. What they call them more like social media journalists. Like they have journalists becoming more influencers as well, becoming brands themselves, becoming like journalists that the readers can relate to. Uh, but I think what you said there on that perspective as well, I think that especially for financial media, that might be even more important. Like, so it's not like that top down, like you said in the beginning. I think that was really interesting where you said that when I mentioned like financial education, that like for many people is like, okay, are you here to tell me how I should invest rather than like us having a dialogue on how I can do this in the best way possible. I don't know.
I agree.
So
And I think to your point, there's the journalists that became brands, but there are also like these almost like key opinion leaders or like key people whose portfolios are also being followed, right, on various apps. So there are these like investment influencers as well who also gather a following and kind of engender we'll call it followership here too.
yeah.
Yeah.
Yeah. And do you see like this is, I don't think you mentioned this, but we do see like you talked about emerging markets and so on as well, like retail investors all around the globe. Maybe there is more of a globalization of retail, like you say like globalization, but like you see like the stocks in the US market is like people, it's not like for the US retail investors themselves anymore. You can have people in India, they
Yeah.
can they can go out and they can buy the Tesla stocks or whatever. So, but do you see that as more people around the world start investing, how do you see like regulators, financial institutions, and the media work together to improve like financial literacy and build trust and even protect investors?
Yeah. I mean, I think this is the trillion-dollar question here because collaboration here is vital. No single constituent can really address this holistically. And I think this is partially why organizations like the Forum are bringing this on to be that platform for collaboration. Because I think what you see is there's a need for people to actually secure their financial futures. And none of these actors alone can do it. Like the government alone are having a tough time providing for their citizens, right? And workplace pensions have also been kind of a less prevalent availability, especially in different parts of the world. So I think that there's a role in collaborating around engendering trust. And I think as we saw, trust in general is declining, which is worrisome. But we see that employers, especially large employers, still usually have the trust of their employees. Of course, they're there for the paycheck, but they frequently are also the sort of intermediary to other, whether it's pension or insurance or other things like to other financial products. And so I think there's really an opportunity to really focus on trust and confidence and empowerment, and not be patronizing about it to the point we made. Like, it's really about each individual or each family really thinking through what they need and what are the ways to get there. And I know this is a bit of a platitude of an answer potentially, or kind of a general answer, but this is that's the challenge. It's that in a world of so many conflicting priorities, right, that governments have to work on now, I think the challenge is that how do you keep prioritizing it, and how do you keep really focusing on like the people and the populations and be kind of human centric about it and their financial security. And I think sometimes that's what I think of the role of our team is like to keep elevating this and keep spotlighting it.
Yeah, super interesting. I think it brings us to the end of this session. But I think, yeah, I think maybe what will be interesting when we have a follow up when you come with your next report, maybe. I think one of you talk about $1 trillion question. I think maybe more the $1 million question for the media industry is like, how can we utilize AI and combine, like you said, like the younger generations are trusting AI, maybe even more, or at least using AI more than maybe more the regular like financial advisors and so on. So maybe how the media industry can use this AI in combination with their own journalism and the content they are like so great at creating. So, but maybe that's more for our follow-up when you have your next report. Yeah, this is very interesting, and a huge thank you to Natalia for sharing such thoughtful insights, and everyone viewing us and for joining us and taking part in this conversation. So yeah, any final words from your side, or?
Just mostly thank you for letting me share some of the insights on behalf of the team, and that I think this is a really exciting development. I think this is, I don't want to lose sight in all of the things that are happening of just the fact that we have individuals around the world, to your point, really eager to learn, really eager to enter markets, really eager to sort of be in the driver's seat of their financial future. And so I think that we can all play at least a small role in empowering them, because this is an opportunity, not a problem. Yeah.
I agree. Okay, thanks again for tuning in, and we look forward to seeing you at our next session.
Great. Thank you. Bye.
Hello, and welcome to our next session in this online event. With everything that's changing in the media landscape right now, and with personalization playing a bigger and bigger role in how people consume news, it raises an interesting question. Could the future of financial journalism start to feel more like a personal investing companion for everyday readers? And related to this, how are Nordic media organizations, often seen as some of the most innovative in the world, approaching this shift? To explore that, we have invited DN to join us today. We will hear now how Norway's leading financial and business newspaper is thinking about this transformation and what they are building for the future. Joining us is Magnus Aabek. He's the development editor at DN. Magnus oversees the DN Investor Platform, a core part of DN's market coverage. And he brings years of experience in editorial innovation, as well as hands-on work with AI in the newsroom. Magnus, thanks so much for joining us.
Thank you, Eirik. It's a pleasure being here. I'll talk you through how we work on personalization with real market data on our investor platform, a very key product of the DN portfolio, and our plans going ahead as well. I'll focus on the investor platform today, but we also have many exciting plans in general with our journalism, of course. To tell you a little bit about Investor, we've been working together with Norkon on the investor platform for about 10 years. It was launched back in 2016 and was really the first digital news outlet in Norway to stream real-time stock market data. We aim to be the preferred destination for Norwegian private investors to stay updated on the market. And it's a key part of our offering to our readers. And it's really where the user need we see is that there's where you can meet market data and journalism. That's very important for us, not just giving the market data, but also give the context with the news and give the alerts with the news as well. This is a very important market driver for us, traffic driver, apologies. We have a high stock market interest across our target groups, among older users, among younger users, whether they work in finance or not, or in banking. there's a very high interest in the Norwegian public about the stock market, especially when it comes to funds in recent years as well. And we are able with the investor platform to offer both news, analysis and portfolio monitoring as well. What we see as well is that the investor user is also more loyal and visitors more often than the regular reader on our pages. I can tell a little bit here. So what we offer to the user when they come here, they have a clear mission. They want to stay updated what's happening in Norwegian and international markets, so it's not just Oslo Børs. And they want to make informed decisions about their investments. With the tool, we are able to let them do technical analysis, follow historic development, get the alerts on stock market announcements, news alerts, etc., and be able to compare their portfolio and how it's developing, compare different stocks. So it's really a key tool for our users for their investment portfolio. And we think that being able to combine that mix of data and journalism as well makes you a better informed investor as well. The typical investor user today, he visits us several times a day. He's usually a male, also sort of middle-aged, but he has substantial personal investments in the market as well. He has money to invest, which also makes him a very attractive user for us, of course, with the subscriptions, but also for our advertisers. And they have often a portfolio they follow with a broad range of companies, for example. And they use the platform to stay updated, curate their own portfolio, get all the news, etc. But let's see. Yeah. And what's important for us with Investor as well is that it's very personalized and is also integrated with our main product. So the screenshots aren't great here, but what you can see, it wasn't a great day for markets either this day. But what you can see is that the top here is our front page, the top of our front page. And then on the bottom there, on the left, is part of the front page of Investor. We are able to get the data from the Investor platform onto our front page of DNNO, and the same on the mobile version as well. So you see the tickers are the same. And this is also that the users both go on Investor, but they also go to DN, and then they have this sort of ecosystem of stock market updates on both platforms as well, and so integrated into each other. It's the same user, same favorites, etc. And they are, of course, able to personalize that ticker with the companies or currencies, etc., that they are interested in. What's been really a success for us after we relaunched as well was we had a specific editorial team who write about, they talk about, they make videos about personal investment, giving advice about how to become a better investor, speaking with profiled investors, but also private investors who have had success in the market. And we see it converts really well. It's really popular among our users. It's some of our most read stories. It's some of the most converting stories, which means that they buy the subscriptions. It's also a very popular newsletter. And we have now also started a new podcast with the same two people, Petter and Sara Sofie, two very talented reporters. And video is also part of their offering. And we see that the way they do their work also attracts a lot younger users as well, which is important for us. As a business paper, we will, of course, have many older readers, and we want to attract younger people who are interested in the markets especially. And this is a way of reaching out to a broader audience as well as being active on social media, of course. Yeah. Going ahead, we see that AI is changing our business, of course, the media landscape. AI is not the solution itself, but we think it can help us solve some user needs. A challenge for us, of course, is that we want to cover the markets, but we have limited resources to do so. So we cover the biggest events, the biggest companies. But we know our readers are interested in the companies they have in their portfolio, that they have invested in. So together with Norkon, we are now exploring to see if we can give a more personalized experience with market updates about companies that they have in their portfolio that they have invested in. So using AI to generate new reports. And what's important here as well is the technology in the bottom, which is not generative AI that does the analysis. That's more algorithm-driven, rule-based, which is technology that Norkon has been working on for years, which is a technology where they can trust to make the right analysis and then generate smaller reports, shorter reports, whether that be short news messages, bullet points, graphics, etc. But we think that this will help people get updates about their portfolio, that they can make even better decisions when they are investing, as well as, of course, getting the broader coverage of the markets from our journalists, which is still key in our offering. For our newsroom as well, it's about working in a more effective way with more powerful tools as well. So one of the things we have been testing as well is having a new market overview monitoring tool that can help us discover the news faster, see the market movements faster, as well as providing context based on our own journalism, our own reporting from external sources that we trust, etc., together with the market data. And this is something we believe that can make our newsroom even stronger in competition with our rivals as well, and help us produce the news faster, broader, and with more context as well. So we're excited about what lies ahead. We think being able to offer a platform like this is really important to make us stand out in a tough competition, but also against new tech companies coming with the AI changing how we consume news, how we find the news, and really about building a stronger brand and being there for our users. I think that was about it.
Very good. Thank you, Magnus. Yeah, as you said as well, it's like DN and Norkon, we've been working together for, I think it's 11 years now, since we first started to build the DN investor platform. It's definitely been quite a journey within the financial media space as well during this period. I think like one of the things you said, I think it's really interesting is how you have more tailored journalism for younger audiences. Like what we say in a way is like previously maybe journalists like back in the 70s, 80s, journalists were like superstars themselves. You had a few journalists being like the brands of many newspapers, but that kind of disappeared a bit after the digital revolution. But now I think we can see more and more about that. But do you see like with like how you use some journalists for younger audiences and different platforms and so on? Do you see traffic going into all your regular content as well from these kind of, for example, Instagram or TikTok or wherever you are, what channels you are using?
We don't necessarily see a lot of traffic coming from especially TikTok, or which we launched an account for this autumn, and Instagram. We don't necessarily direct traffic, but it's really important for our branding and getting people, especially younger people, to learn about what Dagens Næringsliv is and what, for example, the investor platform or our investigative journalism is, or other parts of our reporting as well, our opinion reporting, for example, or journalism. So it's really important to be where the users are without putting our faith in the platform's hands. I think that's a mistake the business has done before, which has been discussed a lot, is that if you rely solely on the external platforms for your traffic, you have a big problem when they start changing their algorithms, whether it's Facebook or Google or other providers. So for us, it's more about getting the brand out there, getting our journalism out there, so people understand more, learn more about us and understand how we work and what we cover, and also that they will, in the end, become users of our newspaper and our services.
Yeah, I think you're focusing on one of like maybe the key elements in lots of media strategies around the world with branding. I remember when I grew up, the pink newspaper of DN was something everyone knew about. It's like it was a synonym to business journalism and financial journalism. And like is that like building a brand again, like a strong brand? Is that a key part of your strategy?
I definitely think so. And there are different ways of doing it, of course. And I think now when we see content is being more sort of diverse in its distribution as well, people not necessarily go to dn.no anymore to get their news. They find it via ChatGPT or not necessarily DN, but all media. They find the news via AI operators, get agents to use it, etc. So if we want to make sure we stay connected to our readers and have growth as well, we need to offer the best journalism, what's unique, which AI can't copy, and build the best products with the best user experience as well, so that you want to use us. And that's great about the investor users, is that they've been loyal for many years, of course. They have invested money for many years and have portfolios that can follow the whole history. But also when we need to attract newer audience as well, who have maybe other expectations than what the most loyal people have.
Yeah, cool. Very good. And yeah, one of the last things you touched on as well was the personalized experiences with AI. That's something we have been working closely together with, looking at some of the challenges we see with expectations of more tailored content and tailored experiences. Do you see this like a larger expectation to more tailored and personalized content from your readers?
I think that will be the expectation, that you need to reach your users with the stuff they're interested in, and when they're in the right mode to meet that content, and also the way they want to consume it as well, whether that's in text, in data, or visual graphs, or audio or video, etc. While maintaining, of course, the strong editorial integrity and qualities as well, so that we have some kind of control still. And what's important with the tools we're looking at now together with you guys is that this is not going to replace our stock market reporting, of course. This is a supplement. Our coverage about the market is still going to be the same strong quality, with investigative pieces, with agenda setting stories, with opinion pieces about the markets. But this is a supplement that allows our readers to follow what they're interested in even more, to be updated about, for example, the companies they invest in.
Yeah, that's what I really like about your approach as well. You don't look at AI as something that will replace the quality journalism that you have. It's more as an addition to actually meet the large demand of your readers, and not necessarily that they are going to your website for the larger, longer articles, and then they go to somewhere else to find the recent insight into the global stock market. But you want to build like the whole ecosystem of everything in one place. I think that's super interesting. I think combined with the brand you have, you're definitely on the right path there.
Thank you.
Yeah. Okay, thank you so much, Magnus. I think if any of the viewers or listeners want to get some more insight, they can reach out to you personally. And you even left your phone number there, so they can give you a call. But you are definitely on the forefront in how we want to combine quality journalism with personalized and tailored content, and utilizing AI in your ways. So I think this, following the development of DN, will be very interesting throughout 2026 for everyone. Thank you. Thank you, everyone. Thank you. Bye.
Hi, everyone. I'm Steve Wilson-Beales, a content strategist and SEO consultant that's been working across a number of industries across the last 25 years. And I want to thank Norkon for inviting me to be their host today. Now, before I introduce my esteemed guest, let me set the scene for today's conversation. So financial publishers are navigating one of the fastest shifts in how audiences discover and trust financial information. Real-time market updates now compete with TikTok explainers, Reddit threads, and AI-generated summaries that reach millions before a newsroom can even hit publish. I think this is something that me and Barry know very well. Younger investors expect transparency, interactive learning, and content tailored to their values, yet distrust institutional voices shaped by legacy finance. Meanwhile, new regulations around financial promotion, the spread of finfluencers, misinformation, and the need to explain increasingly complex tools like AI-driven portfolios are stretching editorial teams beyond traditional reporting. To stay relevant, publishers must combine speed and expertise with education, digital innovation, and a renewed emphasis on credibility. So in this session, we'll explore how financial media can master SEO in this AI-driven era, not just to stay visible, but also to stay trusted. So to help us unpack this, I'm joined by Barry Adams, founder of Polemic Digital, one of the world's leading SEO experts for news and publishing organizations. With over 2 decades of experience, he's advised global media brands, including The Guardian, Fox News, The Independent, Euronews, and News UK. Barry is known for his deep expertise in Google News and Discover optimization, his pragmatic approach to algorithmic changes, and his outspoken advocacy for editorial-first SEO. He's also a frequent speaker at global media conferences, I know because we've met at quite a few, and a trusted voice on the intersection of technology, journalism, and audience discovery. Barry, it's great to have you with us.
Thank you very much for having me, Steve. Quite the introduction. Thank you.
So let's start with a nice, easy one with the big picture, Barry. What do you think are the biggest shifts you've seen in how people discover financial information in the past couple of years, especially with the rise of social and AI-driven content?
Yeah, I think you alluded to it really well in your introduction. Historically, people have relied very heavily on institutional financial news outlets like the Financial Times, Wall Street Journal, Investing.com, and other similar websites. I think what we've seen, especially in the last few years, but maybe at a slower pace even before then, is a drastic shift towards what I'd say user-generated content as sources. Reddit forums are incredibly popular. People rely on TikTok and other social media channels to follow people for investing advice. The rise of crypto has accelerated that because it was basically unclaimed ground, and a lot of new voices tried to build a presence there and have managed to become more than just pure crypto voices, but also just general financial news and financial investing voices. And it's I wouldn't quite say it's a Wild West, but it's not far off of it. That the average person who is interested in it and maybe not educated in all things economics and investing will very quickly gravitate towards these sources because they speak with a lot of confidence and a lot of authority, and they have followings that will share their messages and support what is being said. So it's very seductive for someone who's new to financial news and investing advice to follow those sorts of voices, to go the social media route rather than the classic financial news websites. So I think that's probably the biggest shift that I've seen in the last few years. And it's getting difficult for institutional websites to compete with that effectively. I think there will always be an audience for them, and I am a very strong believer that as people mature in age, their online news consumption, information consumption habits also change. So we maybe shouldn't be too alarmed that 18 to 25-year-olds get their news from TikTok, because I'm pretty sure once they turn into 30 to 35-year-olds, they'll go back to reading websites and using Google. But you want to make sure you stake out your presence fairly early on in their awareness phase. So even if they are still young and still rely on social media channels for the immediate news consumption, they are aware that there are other websites out there with perhaps a slightly different, a slightly more mature voice. So, it's a tough one, and I think a lot of publishers in general, including financial news publishers, are maybe panicking a little bit that they see this shift in user behavior, which is accelerated by, other things that are happening in the search ecosystem with AI overviews, AI mode, ChatGPT, and all those things. and they're not quite sure what to do. I'm of the opinion that perhaps when it comes to reinventing yourself as a news publisher, it may be better to take a moment and see where you are right now and identify what your strengths are as a publisher. And I may be jumping ahead in our conversation here a little bit, but in short, a lot of change, user-generated content, Reddit forums, other types of interactive forums where lay people's voices seem to be spread more widely than what we call the classic experts. I think that's probably the biggest shift that we've seen in the last few years.
Okay, great. So with readers consuming financial content and more financial content through mobile, voice search, and AI summaries, how do these various content formats help publishers maximize dwell time and engagement? So short form explainers, data visualizations, interactive calculators, video snippets, the works. Is it worth the trouble if visitors are satisfied with AI summaries and don't bother visiting websites as much as they used to?
I still think there's definite value in that. There's different types of users and different types of audiences. The users who are satisfied with a very quick summary and an AI overview will never become a loyal reader of your website in the first place. And it's going to be very tough to convert them into like a paid subscriber or someone who will even just register for your website. But there is a demand for deeper analysis, a demand for more detailed background, a demand for expert opinions. Experts have not gone out of fashion. And I think if you as a publisher can provide that, you might not get as much traffic, but I do think the traffic you do get might be more sustainable form of traffic, might be more inclined to register, might be more inclined to subscribe to your paywall, as long as you can provide that extra value that AI overviews can't replicate. And I think that is always the crux of the matter, because we have these huge word generators out there, it's AI overviews in AI mode on Google with ChatGPT, Perplexity, Claude, all of them. If your output is just commoditized news, you're going to have a bad time. If there's not something that really sets you apart, not something that gives you that additional level of expertise and trust, then why are you in the business in the first place? The biggest risk you have as a publisher is to be interchangeable, to be forgettable, to be just another one who reports the same news that everybody else is reporting. You have to find something that makes you different, and that can be deep dives, it can be expert opinions, it can be just different formats that you use, because podcasts are hard to replicate with AI, for example, and videos as well, very hard to do with AI for now. So you have to make sure that you have something unique, something that makes you different, and that can be, under the 50 years of experience as a publisher in the field. But it can also be maybe, if you're a younger publisher, maybe an irreverent look at the financial markets with some stronger opinions that, say, an established player is able to voice. But you have to have that uniqueness, that something that sets you apart and that makes people pay attention, that makes people remember you and makes people want to click on you when you come by in a Google search result, in an AI overview, in a ChatGPT output, so that you can capture that audience at that point and then hopefully convert them into a loyal reader.
It's interesting, isn't it? We've spoken together before at a previous conference around the user needs model, which is a model which has been used by publishers over the last 5 years to identify gaps in their content offering. So if anyone here has not investigated that, that's a good method to just kind of brainstorm with your teams what you can provide outside of just breaking the news. What is truly distinct, and what is your audience sort of really looking for outside of just being updated? Although we know that's very important.
And talking to your audience. I think a lot of publishers are afraid to engage with their readers in a meaningful way. You might send the odd survey out, but that's about the depth of it. But those surveys are often crafted in such a way that you know what kind of answers you're going to get. But having actual conversations with your readers, maybe invite them into an event at your offices or something like that, or go to a roadshow event on multiple locations and ask your subscribers to come to you, and then ask them why they subscribe to you and what they think you're doing well and what they think you might be doing differently or better? And those sorts of conversations can be really eye-opening and might give you a lot of inspiration and ideas on how to develop your news product in different directions, in different formats, and different channels.
Yeah, it's all happening. Many startups now are beginning not only to offer the news, but they also offer the multimodal approach to content, as we're calling it now. So given how Google and ChatGPT now answer questions directly in the answers, let's go to the heart of it with regards to SEO. What does SEO success mean for publishers today?
First and foremost, you don't want to panic. There will be traffic loss. AI overviews on average cause on average probably 1/3 of loss of clicks when there's an AI overview at the top. If you're in the top 10 search results, and there's an AI overview above you, you're gonna see some traffic loss. But at the same time, don't throw out the baby with the bathwater. Google remains by far the largest source of traffic for pretty much any website out there. That hasn't changed. It's just a slightly smaller pie. I feel that for many years, too many publishers have sort of relied on Google's own growth to fuel their growth in traffic, and that they haven't really competed effectively in Google. Because Google search has been growing and has continued to grow for the last 20 years. I think now, while Google still reports the total amount of searches is increasing, and I actually believe them in that front, the amount of clicks that they send to the web isn't increasing. Because more searches are happening, but there's also more AI overviews and more direct answers, and therefore less need for users to click through to websites. So I think we need to understand we're now in an ecosystem where search as a channel has flatlined. Which means just maintaining traffic is actually a victory, and you need to celebrate that, because there's a lot of publishers out there who are losing traffic, and the ones who are maintaining traffic are the ones who actually are doing well. Search as a growth channel is only really applicable to fairly young publishers or publishers that aren't necessarily SEO mature, that still have a lot of optimization to do and a lot of improvements to make. But SEO mature organizations, just keeping the traffic that they have, I think, that's sort of the new normal. And that is a paradigm shift you're going to have to accept internally and externally as well. And that might be hard for stakeholders.
Yeah.
But that also means that SEO becomes more important, because if you don't do it, you will be on the losing side. It's become more competitive. SEO, up till probably the last year or two, wasn't really a zero-sum game, because even if you're number 2 and someone else is number 1, you'd still get traffic, and there was plenty of traffic to go around because the amount of searches was still growing, the amount of clicks Google sent to the web was still growing. But now that has flatlined, it is totally zero-sum game. If someone gets the click, you don't get it, and vice versa. If you get the click, someone else doesn't get it. So it's become more competitive, which means you're going to have to work harder at it. You're going to have to fight harder to get those clicks. And again, a lot of publishers perhaps have been coasting a little bit, especially if they're, fairly bigger brands. In my experience, when you look at the bigger brands in news and publishing, they often perform well in Google, not because of their SEO, but because they are a big brand, and they capitalize a lot on that brand recognition and people preferring them over maybe a lesser known publisher. That has also been changing, also in financial news and in other news outlets, where people feel more confident to click on any top ranked result, because they feel Google is doing the quality evaluation for them, which is relatively accurate, not always, but you can usually rely on a top stories article to come from a fairly reputable and trustworthy publisher.
Yeah.
So you're going to have to work harder to maintain the traffic, to get those clicks, and to make sure that you're not losing out to somebody else. And that means you have to invest, maybe not invest more in SEO, but make sure you be smart about how you do SEO, and make sure that you don't neglect it as a channel. Because it's still going to send probably half your total traffic to your website. And if you neglect it, that can very drastically go down, because someone else is just going to steal your lunch right from under you. So we are also offered some additional traffic sources by Google. For example, Google Discover is becoming a huge source of traffic. However, in the financial news niche, that's probably not going to get a lot of traction for you. Discover is much more geared towards hobbies and general interests, rather than financial news, business news, that sort of stuff. In my experience working with all kinds of publishers of all different stripes, B2B focused websites and business and financial news websites are not getting a lot of traffic from Discover. And I don't see that changing, just of the way Discover works as sort of a social news feed without the social aspect, basically. So you can't rely on Discover to make up the shortfall that maybe your loss of search is creating, whereas other publishers can make that switch fairly comfortably.
Well, I was going to ask you, what, like, as you work with some of the world's biggest media brands, what do even the biggest publishers are getting wrong with their SEO strategy? But it sounds like you might have touched on some of it there.
Yeah, a lot of them are relying just on their brand power to do the heavy lifting for them. And for some of them that works really well, and that's fine. But others are maybe seeing that, oh, wait a minute, we're maybe not doing things as we should. A lot of it is editorial, in that the journalists don't feel the need to optimize articles in a way that it gathers visibility and gathers clicks from Google. Because, hey, we are brand X and we've been around for 200 years and people trust us, so we can write whatever. And that is a sort of position of arrogance and self-confidence that's maybe not entirely deserved. Because, yes, you have probably a very strong cohort of loyal readers, but if you want to grow your subscribers, you want to grow your readers, you're going to have to try and pull different people in. And that means you have to be where they are, which in the context of news of all stripes is still primarily Google. People do like using search as a channel to find out about news. And other things that are technical, in that the websites are usually, because the larger publishers also have very big and complex websites, that there's a certain amount of technical debt on those websites that impacts how Google can crawl and index your content. And there's certain decisions being made from a very commercial angle, which don't necessarily have a positive impact on how search and SEO works on the website. So again, it's sometimes it's a bit confrontational for news publishers to understand that they might be the biggest news brand in their particular area, but they're still losing in Google, and that they actually have to work for their audience, they have to work for their traffic. There's sometimes with some publishers, not all of them, mind you, but some of them that I've worked with, is maybe a bit of a sense of entitlement that, hey, we should always get the click because we are this big brand. And that's not quite how it works on Google. There is a certain preference for stronger brands in Google, but unknown brands or lesser brands that are better at SEO can still outrank you, can still outperform you, because they're just better at it and better optimized content, better optimized websites, and sending better signals to Google about the quality and relevance of their content. So you have to still work at it. You just have to still fight at it and just not take it for granted, really.
Yeah. Do you think financial publishers and services should be investing more in video?
Yes, that's an absolute no-brainer. If you have, I've written about this before, and it's something that other people have also been advocating for many, many years. And I think the rise of AI has really accelerated that mind shift. If you have a really good piece of journalism, like a proper investigative report, for example, why not put two of your journalists in a room with microphones in front of them and have them talk about it? Have them explain the story, the background of the story, and the lessons learned from the story. So there's a podcast right there. Yeah. Video that conversation, and now you've got a video, an hour and a half long YouTube video. Cut that video up into 30, 40, 50 little slices. Now you've got shorts that you can put on YouTube, you can put on Instagram, you can put on TikTok. And that's how people love consuming content. That's how people are first exposed, perhaps, to your content. Bit like little short form videos based on that one piece of journalism that you do. And that also is a bit of a shift, and you've mentioned it before in the introduction, the rise of finfluencers. And it's not just something that I see in the financial news industry. I see it all across news, where journalists maybe need to become a bit more comfortable being public figures. Or maybe not all of the newsroom, but some people in the newsroom who maybe feel comfortable with that particular role. But they become sort of spokespeople for the outlet and get in front of a camera and talk about the stories of the day or the week and do record those podcasts and those videos. Because we as people love listening to other people and watching other people. And that's why podcasts are so popular, that's why video is so popular. And that is an area where I think especially traditional and slow-moving news publishers, which financial news generally is, has maybe been a bit slow to adopt that, which has left others to claim that space for them to a certain extent. But there's nothing stopping established publishers from now also stepping into that. There's no such thing as being too late with that. You can still launch a YouTube channel and gain followers and become successful. It's not a saturated market by any stretch of the imagination. Still launch a new podcast. I mean, like there's tech pros launching podcasts every day with absolutely no expertise and no background. So if you come at it with expertise, with good stories to tell, which is your business as a publisher, then I think you might be surprised by how much traction you get and how quickly you build a loyal audience. And the beauty of those channels is you don't need massive audiences to make them very profitable and very engaging channels that then also drive traffic to your website and drive subscribers and drive loyal readers.
I think you're right there. What we've also seen is, particularly in news media, is those companies that may have invested in long form previously, and maybe it didn't work for them, and have been apprehensive of investing again in video. What they've done is actually invested in short form 16:9 video. It's worked really well, and then it's allowed them to invest more in more long form format. So there's loads of evidence across the US and UK media. Speaking to one of your points about authenticity, which you can achieve through video, you've talked a lot previously about EAT, experience, expertise, authoritativeness, and trustworthiness, which is always a huge mouthful. In financial media, what does that actually look like in practice, and how can publishers signal real expertise when AI and influencers flood that space?
Yeah, that's a very good question. You have to keep in mind the EAT that Google talks about in the context of the quality raters are more almost subjective evaluations that people who work for Google to monitor the quality of their search results then evaluate the website on. They fill in a form and they do their ratings and then send it off to Google, so that Google is trying to capture hard data about subjective experiences. But can this website be trusted? Is the tone of voice accurate? Do we know who the people behind the website are? Those sorts of things. And there are some things that you as a publisher can do to tick those boxes. You have to have a fairly decent About Us page that talks about who you are, what your history is, what your purpose is as a publisher, your editorial policies, how you source your news, what your business model is, basically. And again, to the point we made earlier about people wanting to listen to people, make sure you have named bylines that people can click on and see information about the journalist in question with a photo, maybe a short bio, links to their active social media profiles, links even to other websites that they write for. Because those are all very strong trust signals, You shouldn't be afraid to link out to competing websites if you have a journalist that writes for them, because it makes that journalist more authoritative, it gives them more expertise in people's perception, and that then reflects on your website in a positive way. And always make sure that you explain how you source your stories, where your information comes from as much as you can, so that people get a bit of a sense that you've done your research, that you have really good editorial processes that prevent you from publishing falsehoods, that there is a policy where people can file complaints or spot inaccuracies and things like that. And all of those signals, they're subjective measurements when someone comes to your website, but they tend to translate into signals that Google can directly measure, like people spending more time on your website, reading more articles on your website. And those sort of signals can be very powerful in how Google understands your website and the brand. And also if people search more for your brand on Google, that's a very powerful signal for Google, because Google realizes, people actively want your website and your content. So it's a lot of different things you have to have in place to make sure you have those signals there, and that users and search engines understand that you are a trustworthy publisher and can stand behind the content that you publish.
And really it'd be interesting how publishers take that and align it with another trend that we're seeing is, should financial publishers invest in structured data experiences like live rates, compare returns, AI-driven recommendations that directly answer the intent-based queries?
I'm going to be controversial here and say no, because that's commoditized information. If you do a search for a stock ticker, the answer is right there in Google search results. If you, sure, have stock tickers on your website, but don't go overboard. Just take a third-party source and publish them on your website, because that's not information gain. That's not new. That's not you adding something new to the conversation. You can go to any financial news website and see stock tickers. So you have to have something different. And I also think maybe people overestimate Google's and other AI systems' reliance on structured data a little bit. We have this idea in our head as an SEO industry that Google loves structured data, and because it's making content machine readable and explaining the context and purpose of content. In practice, I don't necessarily see that in reflected in how Google crawls and indexes and ranks web pages. I think Google uses structured data in some context for specific enrichments of search results, like reviews or articles and top stories or video thumbnails and things like that. Beyond that, I don't think there is much evidence, if any, that Google actually builds intricate entity graphs based on structured data. And I think that's on purpose, because structured data, for all the hype that we as an SEO industry have thrown behind it, isn't widely adopted on the web. This is still low single-digit percentage websites that actually have structured data in a meaningful way on their site. So of course Google is not going to rely on that, because it would skew the playing field drastically in the advantage of websites who do it versus websites who don't. And it's not necessarily a quality indication either, having structured data on the website. It just means you might have more development resources than your competitor, but doesn't mean you have necessarily better journalism than your competitor. So I think, do the necessities, do the basics really, really well. And present to your audience what they want in the format that they want it. But that sort of general information about stock market movements and trading is fairly commoditized. And, you should have it on your website to a degree, to the extent that your readers expect it of you. But I don't necessarily think it's an avenue for you to establish yourself as a different kind of player and can bind a loyal audience to you.
Fair play. So moving on, many of the people watching this interview will most likely lead subscription-driven organizations. So how should they think about SEO beyond traffic as a driver for retention and trust?
Absolutely. Google doesn't necessarily penalize paywalled articles in its ecosystem, and that's a very conscious decision that they've made. Google will allow a paywalled article to rank in a top stories box or in a Google search result right next to a free-to-read article. The risk you have is that you have a very high bounce rate if someone clicks on a paywalled article and then gets the paywall in front of them, which is why I'm actually quite a fan of dynamic paywalls or metered paywalls or even freemium models where part of your content is entirely free, because it allows people to sample your content and sort of get a bit of a gauge for it. Unless, of course, you have such a strong USP that you don't need to make anything for free and you still get your subscribers, which some publishers do. But a lot of publishers don't have that luxury and they need to still win over an audience. So there needs to be a certain amount of allowing people to sample what you have before the paywall comes up. So yeah, dynamic paywalls, I'm a big fan of those, especially the smarter ones that are now very personalized and tend to be able to trigger at a point where it's a very high likelihood of someone converting to a subscriber. Even with like special offers, like special discounts for X amount of time to read this before you get the full price, those sorts of things, the classic sales mechanisms really. And I do think paywalls are the future of news in general, including financial news. I think if you have something unique, which we've talked about already before, and have something that people will actively seek out, then it is worth people to pay for. I think advertising is not going to be sufficient as a business model for most publishers anymore, and there needs to be additional revenue streams, and paywalls is a very good revenue stream for that. And again, if you are just a commoditized news publisher that doesn't add anything new to the ecosystem, paywall isn't going to work for you, because they're just going to go somewhere else and read the same news. So you do have to have something that people are willing to pay for. And if you have that, then it's perfectly fine to ask people to pay for that. I'm a big proponent of paywalls. And that is actually an opinion I had to change. Because if you asked me the same question 10 years ago, I would have said, nah, don't do paywalls. It's absolute suicide. And now I'm the opposite. No, actually, no, you probably should do a paywall and make sure you have the right model that fits your particular brand and your output.
Okay, so on the kind of a closely related topic on that, are there any specific metrics you'd recommend to measure audience trust or engagement through organic channels besides clicks?
Yeah, clicks, of course, still a big measure, but also how often people search for your specific brand, because that is a good signal that people want your content. And again, ask your audience, what do they think about you? What do they think your strengths as a publisher are and your weaknesses as a publisher are? You can always try to find indirect metrics and data points that might tell a story, but nothing beats someone actually saying it to you, to your face. Like, oh no, this is what I think about you as a company. And, you shouldn't be afraid of that. You should embrace it. You should welcome it. And not necessarily always listen to your audience, but at the very least, take on board what they have to say when you make your big strategic decisions about, the next 5 to 10 years as a publisher.
Okay. So we're sort of approaching the end of our time here, but if you're advising a publisher CEO right now, what 2 strategic SEO-related investments would you make heading into 2026?
That's a very good question.
Mm-hmm.
I think a lot of the issues I see that publishers have to do with their technology stack, and I'm quite a fan of publishers choosing to simplify the technology that they run on. I also think not every publisher should also be a technology company. There's still a lot of publishers who build everything in-house and have their in-house CMS, in-house video platforms, and all of those things. I actually think for a lot of publishers that's a bit of a waste of effort. It's a waste of resources, because there's other specialized companies who can do that for you. And they have a very strong incentive to constantly improve their platforms, improve their systems as the market moves along. So I think a lot of publishers should probably step off of custom CMSs and just partner with a specialized publishing CMS provider and let them do the heavy lifting so that you can focus on what your core business is, which is financial news. So I think that's probably a very smart strategic investment for publishers. Look at your technology stack, simplify it as much as possible. And yes, integrating AI into the publishing workflows in such a way that it alleviates the workload of your journalists to an extent. I think this is one area where large language models actually add a lot of value, where you can ask the LLM to generate an SEO optimized headline for you, SEO optimized open graph social headline, SEO optimized introduction sentence as well. And that just makes it a bit easier for publishers to get the content out there in an optimized way without having to hammer that point home with every single journalist that writes for them. Also things like internal linking to topic and tag pages, that can be pretty much fully automated now, because the AI systems have gotten smart enough that they recognize named entities, recognize whether or not you have a tag page for them, and then automatically insert the link there, which is very good for SEO and very good for topic authority signals. So I'm thinking more about those sorts of investments. Outside of the big picture strategic stuff we've talked about now, where you can just make sure that your technology stack is lean and simple and outputs a website that is very easily crawlable and indexable for Google, and that you have the right integrations of AI tools in your workflows that enables journalists to publish SEO optimized articles without having to understand a lot of SEO themselves.
Perfect. Right. So, Barry, I think what we'll do, we'll bring the session to a close, but we could talk a lot more as we have done. And we are continuously doing as an SEO community over the last couple of years with the introduction of more and more AI. It seems like we're spending more and more time each morning catching up on the news and what everyone else is saying about this. So it's a very busy time for SEOs, as it is for all aspects of the digital and publishing industry. And I think I hope at least that today's session will spark some ideas on how financial publishers can not only ensure how they can protect their quality journalism, but also remain visible and continue to remain visible in AI. So thanks, Barry, and I hope to talk to you again very soon.
Absolutely. Thanks very much for having me, Steve.